In this video, you will learn everything you need to know about cost volume profit or CVP analysis. We'll break down fixed costs, variable costs, contribution margin, break-even point, margin of safety, and operating leverage in clear and simple way. Stay with me until the end and you'll understand it all clearly. So let's begin. Cost volume profit or CVP analysis, also known as break-even analysis, is a tool used to understand the relationship between companies' costs, sales volume, and profit. It helps businesses determine how changing sales price, production levels, and costs affect profitability. Essentially, CVP analysis shows how many units a business needs to sell to cover all their costs and start making a profit. The purpose of CVP analysis is to help businesses make informed decisions about pricing, production levels, and cost management. By understanding how these elements affect profits, businesses can set goals, plan for different scenarios, and make decisions that increase profitability. There are four key components in CVP analysis. The first one is selling price. It's the price at which a business sells its products or services, and it's a key factor in determining revenue. The second component is cost. Costs are expenses associated with producing and selling products. There are two types of costs, fixed costs and variable costs. Fixed costs are costs that do not change regardless of the number of units sold, such as salaries, rent, and insurance. Variable costs are costs that change with the number of units sold, like raw materials or labor. The third key component of CVP analysis is volume. It refers to the number of units sold. The higher the volume, the more revenue is generated, which can help cover fixed costs. The fourth key component is profit. Profit is the amount remaining after all costs are subtracted from revenue. Profit is the goal of any business, and CVP analysis helps us predict how different sales levels impact profit. In CVP analysis, certain assumptions are made to keep things simple and predictable. First, costs are split into fixed and variable categories. Second, sales price per unit, variable cost per unit, and total fixed cost remains constant no matter how much units are sold. Third, the number of units sold equals the number produced, meaning no changes in inventory. Finally, we assume that both costs and revenues behave in a linear way, meaning they follow a steady and predictable pattern. By using these assumptions, CVP analysis becomes a powerful tool to help businesses make decisions that maximize profit and minimize risks. Now let's talk about contribution margin, one of the most important concepts in CVP analysis. Contribution margin is the amount left from sales after covering variable costs. It shows how much money is available to cover fixed costs and generate profit. The formula is simple. Contribution margin is equal to sales revenue minus variable costs, and this can be calculated for a single unit or for total sales. The contribution margin per unit tells us how much profit each unit contributes after variable costs are covered, while the total contribution margin shows the overall amount available to cover fixed costs. Another useful way to express contribution margin is contribution margin ratio, which is found by dividing contribution margin by sales. This percentage tells us how much of each dollar in sales goes towards covering fixed costs and profit. Understanding contribution margin is key because it helps businesses decide pricing, cost control, and profitability. A higher contribution margin means a company keeps more from each sale, while a lower margin means less money is available to cover fixed costs and profit. In short, contribution margin helps businesses understand if their pricing and costs are set up for profit or if adjustments are needed. Now let's focus on break-even point. The break-even point is the sales level where total revenue equals total costs, meaning there is no profit and no loss. At this point, a business has covered all its fixed and variable costs but hasn't made any extra money yet. The break-even point can be calculated in units or dollars. To find the break-even point in units, we divide total fixed costs by contribution margin per unit. This tells us exactly how many units must be sold to cover costs. To find it in dollars, we divide total fixed costs by contribution margin ratio, which shows the total sales revenue needed to break even. Understanding the break-even point is crucial because it helps businesses set sales targets, adjust pricing, and control costs. If sales are below this point, the business is losing money. If sales go above it, every extra unit sold adds to profit. Simply put, the break-even point tells businesses the minimum sales they need to stay afloat and start making a profit. Now let us talk about the margin of safety, a key measure of financial risk. It shows how much sales can drop before a business reaches its break-even point, helping to assess stability. It's calculated as margin of safety equals actual sales minus break-even sales. To express it as a percentage, we use margin of safety divided by actual sales times 100. A higher margin means a business has a cushion against losses, while a lower margin means even a smaller sales drop could cause financial trouble. The margin of safety is crucial for decision making. A lower margin may signal the need to cut costs, increase sales, or adjust pricing to avoid losses. Businesses use it to evaluate risks before making a big financial moves. In short, margin of safety measures how much breathing room a business has before hitting break-even, making it a key factor in financial planning. Now let us talk about operating leverage, a key concept that shows how sensitive a company's profit is to change in sales. It shows how fixed costs impact earnings when sales go up or down. Businesses with high operating leverage have more fixed costs and fewer variable costs. This means that when sales increase, profits grow faster, but when sales drop, losses happen quickly. On the other hand, businesses with low operating leverage have more variable costs, making their profits more stable but with a slower growth. Operating leverage is calculated using the degree of operating leverage or DOL formula, which is contribution margin divided by net operating income. A higher DOL means profits are more sensitive to sales changes. Understanding operating leverage helps businesses manage risk. Companies with high fixed costs need consistent sales to stay profitable, while those with low fixed costs are more flexible during downturns. In simple terms, operating leverage determines how much profit changes with sales, making it a crucial factor in business decision making. That's all for today's topic on CVP analysis. If you find this video helpful, make sure to like, share, and subscribe for more easy to understand accounting lessons. Thanks for watching and see you in the next video.